I have to say that I took as the subject of this exposition, which I try to be short, risk and monetary policy, and I would, of course, stand ready to respond to any question that you have. Let me say first that financial innovation is part of scientific progress. It is an engine for growth and prosperity. Yet the key question, which I would like to highlight in these remarks, is to what extent financial innovation serves the real economy and to what extent, from time to time, it serves only itself. At some point in our recent past, finance looks like losing contact with its raison d'être. It ceased to be a source of services for the real economy and developed something like a life of its own. Finance became self-referential. I will briefly review the driving forces that led to this situation and the profound crisis that followed. Financial crises have been a recurrent feature in human history, and I would take you back 2 millennia in Europe to see how the great historian Tacitus described the financial crisis that hit the Roman Empire in the year 33 before Christ. He wrote in the Annals, "The destruction of private wealth precipitated the fall of rank and reputation. At last, the emperor interposed his aid by distributing, throughout the banks, 100 million sesterces and allowing freedom to borrow without interest for 3 years, provided the borrower gave security to the state in land to double the amount. Credit was thus restored, and gradually private lenders were found. Replace emperor with governments and central banks, sesterces with dollars or euro, security with the word collateral. This 2,000 years old quotation couldn't sound surprisingly familiar. Yet, even though 2,000 years have passed, with many financial debacles in between, I think it is fair to say that we entered the current crisis less than ideally prepared. First, we had to improvise with an economic interpretation of the causes that led to these unprecedented market disruptions. The dramatic fall in confidence revealed a source of risk that macroeconomists had not modeled carefully and that had not even been considered relevant by most theorists of finance. Now, the concept of systemic risk is almost common knowledge, unfortunately. Second, we had thought that the financial system would act as a shock absorber. Portfolio theory had demonstrated that the dispersion of individual risks would attenuate aggregate risk, but the mispricing of risk multiplied exposures, and the assumption of similar risks by market participants increased the potential for contagion. In the event, we learned that dispersion does not necessarily mean effective diversification. Third, as central bankers, we had to design intervention strategies that had not been studied in recent times. The extraordinary liquidity measures that central banks took at the height of the crisis on both sides of the Atlantic had been expelled from the economics textbooks. Modern monetary economics had suggested that unlimited arbitrage in financial markets would make such measures irrelevant and unnecessary. In the event, amid conditions of extreme uncertainty, private arbitrage became unavailable. As in ancient Rome, public credit became vital because private finance had, at least temporarily, disappeared.